Opening Hook challenged the assumption we're told money is neutral, a simple tool, a store of value. But what if money stopped being a measure of value a long time ago and quietly became a contract of control, a system where participation is mandatory, exit is punished, and the rules are written by institutions you never voted for? If money is just value, why does it come with conditions, dependencies, and lifelong obligations? Setting the stage, background, and tease for most of human history. Money was tangible. Grain, silver, gold, things that existed before authority stamped its seal on them. Kings could debase coins, but they couldn't create value from nothing. That changed when banking, states, and debt merged into a single system. The twist? Control didn't arrive with force. It arrived with convenience. Origins: money as value. Early money emerged naturally from trade. Gold and silver worked because they were scarce, durable, and independent of rulers. Debt existed, but it was personal and limited. Power was constrained by what could actually be collected. Value came first. Authority followed. Rise money as credit. The shift began with centralized banking and state-backed debt. Governments discovered they could fund wars and expansion, not by taxing immediately, but by borrowing against the future. Banks learned they didn't need to lend existing money-only promises. Fractional reserve banking turned deposits into leverage. Money became credit. Credit became policy. Breaking point: money detaches from reality. The final break came when currencies were severed from gold. From that moment, money no longer represented stored value, it represented obligation. Every unit issued required future labor to justify it. Inflation wasn't a bug, it was a feature. The system now depended on constant growth, constant debt, and constant participation. Fallout control through dependence: once money became debt, survival required access to the system. Wages, housing, education, everything priced in obligations. Governments could print, banks could lend, but individuals could only earn or borrow. Control shifted from ownership to access. Failed fixes, repeating the pattern. Each crisis promised reform. Each reform expanded the same mechanisms: more liquidity, more leverage, more complexity. The solution to debt was always more debt. Modern parallels: the pattern continues. Today, global debt exceeds global production many times over. Entire economies run on rollover and belief. Digital currencies, social credit systems, and programmable money hint at the next phase. Money that doesn't just measure behavior, but enforces it. 3 takeaways. First, money didn't fail accidentally, evolved intentionally. Second, when money is debt, control is structural, not personal. Third, systems built on obligation always demand obedience. Closing warning and call to action: the real question isn't whether the system will change, but who it will serve when it does. If money defines freedom, understanding it becomes an act of resistance. If this made you rethink what money really is, subscribe, share this perspective. Stay curious, because the rules only stay hidden when no one looks too closely.